Hello, this is Manesh Patel with Ichimoku Trade. Today is January 27, 2016. Today we had the U.S. Fed rate make a decision on the interest rates. It caused a lot of volatility and everything. And what we want to do is kind of show you a quick day trade that we took today. And we're going to show you this with our student account with one contract with a weekly option to kind of show you what you could do with just one contract. Okay, so let's begin. Before we begin, let's go for our normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing it at your own risk. All information is owned by EII Capital Group, cannot be copied or distributed without our written permission. We are broker neutral, so we support eSignal, TD Ameritrade from Thinkorswim, and so forth. Today's charts, we're going to be using Thinkorswim from TD Ameritrade, not eSignal, since we're going to be dealing with weekly options and showing you how you could do day trading with weekly options. Here's our contact information, so if you have any questions, let us know here. Okay. Now, what we're going to do is, before we sit there and look at any day trades, we always want to make sure we're trading with the higher time frames. And the reason why is that basically increases our probability of success. We're looking for a high reward risk of 3 to 1 with a high win-loss ratio. Okay, so what we're going to do is we're going to sit there and look at our higher time frames, both the daily, weekly, and monthly, and we're going to look to see what the story is. If they all tell us the same story, then we're going to be able to sit there and look for a day trade. If they don't tell us the same story, then we're going to move on and try to find another instrument. If you look at the monthly time frame here, and remember, in order for something to be bullish in the Ichimoku world, it has to be above the green line and above the cloud. This here is not bullish at all. It basically went below the green line here, so all the people that were bullish on the long-term basis on the monthly chart are no longer bullish at all. In fact, this has a high probability of now going for a major pullback. So this right here is going for a pullback, so this is bearish short term. Okay. On a weekly time frame, this is below the cloud and below the green line, so the sentiment's bearish here. And on the daily, the sentiment's bearish too here, because this is below the cloud and below the green line too. So this is bearish. That means I could only sit there before the Fed rate decision and after the Fed rate decision, sit there and look for bearish trades. I cannot look for bullish trades at all. So if you look at what happened before the Fed rate decision, let's go to a 1 hour and keep it simple. And 1 hour before the Fed rate decision, which is right here, you had a support right here, which is roughly about 1894.75 on a 1 hour. So that was a 1 hour support there. If you look on a 30-minute, it was a support here for the 30-minute. If you look at a 10-minute, it was a support here for the 10-minute. So 10-minute, 30-minute, all the day traders were thinking that this was a support there. The 1 hour people were thinking that the support was there too, so this means the swing traders are thinking the same way. Okay, let's look at one swing trading time frame, another one, a 2 hour. And if you look on a 2 hour, the red line here, the support was almost at that level too. So the 2 hour was almost thinking the same way too. And if you go to a 4 hour here, there was not really a support up here. Okay, so basically what happened is that there was a multiple time frame support where the day traders and swing traders were basically bullish, and they were at this point right there, they were bullish. As long as price remained above the support, basically the day trades and the swing traders were basically going to be bullish. Now, we could not put a bullish pullback order here because the higher time frames are bearish. Okay, so what we need for it to do is for this multiple time frame support to be broken. Once that's broken, we now could set up a trade. So what we did was we patiently waited before the Fed announcement, and you could see here before the Fed announcement the markets went up. Okay, and then just kind of consolidating and stuff like here. Before the Fed announcement here, the markets looked like they were about to retest this high and keep on going higher. When the Fed announcement came, the markets looked like they went higher. Eventually what happened is it slowly started coming down, and in 10 minutes it closed below this bar right here. Once we closed below that bar right there, we broke the multiple time frame support. Okay, that MTF support now became an MTF resistance. So then what we did was we waited for price to get to this point right here, and we basically shorted the stock market using SPY weekly options, okay, for a quick day trade. So our entry was going to be here. Our stop was going to be a little about whoops, about right here. And if you look at where our profit target was going to be, is going to be roughly about here. Okay, so if you look at this, this was a 3-to-1 reward risk ratio, which is exactly what we're looking for day trading. Now, if you're entering with one contract, you need to exit at this point right here. If you're entering with multiple contracts, what you would do is you will exit 50 to 75% of your positions at that point there, and then what you do is you trail with a buffer above the red line. Okay, so if you look in this scenario here, what happened was we got to our target, so people that had one contract exited the trade. That people that had multiple contracts, you're basically in huge profits right now, where you're at least looking at 10-to-1 reward risk ratio and higher, and you're still in this trade because the stop is still right here. Okay, so you're still in this trade and you're carrying this market all the way down. Let me show you basically the trade here, and you could see the trade here. We opened up and we bought the weekly SPY options here. These were the 190 puts. We bought them for $2.72. Okay, when it got to our target, we sold them for $3.23. So basically, we walked away with $51 per contract here for one contract. That's not bad at all. Okay, and the reason why is, if you think about it, we didn't risk the entire $2.72 at all. A lot of people say we risked this $2.72, so you risked $272 to make 51. No, we didn't do that. What happened was we had our stop here on the charts. If price had gotten here, we would have exited that position. So what happened is that we would have lost a couple of dollars off this 272. So overall, we still walked away with a 3-to-1. So this is showing you how you could quickly day trade off the Fed rate decisions using Ichimoku multiple time frame support resistances. In this scenario here, we had an MTF support, but it did not sit there and follow what the higher time frames were doing. So we could not sit there and take a bullish trade at all. And luckily we didn't do that, because we would have been stopped out. So the higher time frames were bearish. We had to wait for this MTF support to be broken, which we did. Once it broke, it became an MTF resistance. We waited for price to come back to that. As soon as it did, we shorted the market and we played to the bottom of the consolidation pattern, which was here with high probability. If you had multiple contracts, when you got to the bottom of the consolidation pattern, you protected your profits and you with a tight stop, and you kept on riding it down as far as it could go. So that's a quick summary of basically how you sit there and trade with multiple Ichimoku multiple time frame support resistances, and how you could safely trade around the Fed rate decisions using weekly options.